But we'll dive right into it. So um, essentially, today we're going to go through retirement lending, more specifically reverse mortgages. So we'll just hop right in there because there is a lot to do with reverse mortgages, and we'll go right into this slide here. Okay, so I wanted to hop in and kind of go why this matters to you first. So first and foremost, this is like NAR data. 49% of all home buyers are age 60 or older, yet less than 1% use a reverse mortgage to purchase. Now, caveat that with reverse mortgage isn't for everybody. So it makes sense as lower, but 1%, less than 1% is kind of low if people understood what it actually was and what it's good for and not so great for. 60% of buyers in their 60s and 50% of those in their 70s finance their home purchase. So there's a massive market out there that could benefit from a HECM, which I'll get into what that is, but it's reverse mortgage. Understanding this product could mean close more deals and better service to senior clients. So today's goal is just to give you knowledge to identify opportunities and confidently refer clients. So have an understanding of what this is and what it isn't. Agenda, pretty straightforward. What is a HECM? How the numbers work? Who qualifies? What agents need to know? Spotting candidates, myths versus facts. All right. So what is a HECM? So the HECM stands for Home Equity Conversion Mortgage. It's the most common reverse mortgage, and it's the one that's backed by or insured by FHA. Age requirements. So the main borrower, has to be, any borrowers on it must be 62 or older to qualify. So there is an age requirement. There is no monthly payment requirement for principal or interest. So as far as a mortgage payment is concerned, there is no technical mortgage payment. They still do have to pay taxes and insurance, not surprisingly, I suppose. But ownership, borrower retains full ownership and title to the home. It's a non-recourse loan, meaning borrowers or their heirs, if when borrowers pass away, they never owe more than what the home is worth. Repayment loan is not repaid until a maturity event occurs. We'll come back to that later as well. And then that follows the same, you have to think about it a little bit differently, but it's the same type of FHA loan limit. In this case, they call it a maximum claim amount for reverse mortgages. But it's a limit on what they'll actually do as far as a claim. It doesn't mean that someone can't buy a home that's more than $1.2 million. It means all their calculations, how much money is going to have to be required to be put down, is going to be based on that maximum claim amount. All right, so how does a reverse mortgage work? So on the left, we have a traditional mortgage. You can see that the loan balance starts high and then it goes down as the years progress because people are paying into principal. They're obviously paying interest, but a chunk of their payment goes to principal. Early on, that's smaller. Later on, more of that goes. Reverse mortgages work in reverse. So you start with a lower loan amount, and then over time, the loan balance increases. But the nice thing obviously is the borrower stays in the home and retains ownership. So sometimes, not all the time, but sometimes people are making these decisions on whether or not to get a reverse mortgage based on the ability to stay in the home that they want to stay in or not, whether it's going to a home care facility or whatever the case may be, having to live with family, anything like that. So it really can open up an area of flexibility for those older individuals to take advantage of some programs that exist for them. Okay, so I'm gonna go back real quick. So the key takeaway is that the borrower trades future equity for present day cash flow and financial flexibility. I can't emphasize that enough. It's not like, as you may have noticed in some of the classes that we teach, especially around loan products, there is like some good things about the product, some benefits, some pros and some cons, right? So this is not a product for everyone. It doesn't fit everyone. It's not designed for everyone. It's designed to help. And what it helps the best with is to preserve cash flow and financial flexibility for some borrowers. And we'll get back to that as well here in a little bit. All right, so borrower eligibility at a glance. So again, 62 or older, at least one borrower must be that. Primary residence, they have to live and occupy the home as their primary residence. There's going to be a financial assessment that's done along with this residual income. Essentially, what it's going to gauge is the borrower's ability and willingness to repay the obligations. So the obligations in this case would be their taxes, their insurance, and just some of their other stuff on their credit report, everyday living expense stuff that they might have. So there's an analysis that gets done, and the reason I bring this up is, and we'll get to this later as well. There's previously in prior years of reverse mortgages, that was not always the case. And there were some difficulties surrounding borrowers' ability to make those payments after they get the reverse mortgage and all that nonsense. So really important. Those ones are really important. HUD counseling. So the borrower has to complete a HUD counseling for a reverse mortgage, and it's done by a third party. And they essentially go through and they check the borrower's understanding. It's not like a test. They're just helping to make sure and kind of walking through the product with them and helping them to really understand and checking their understanding to make sure that they're confident and comfortable with the product, what it is for, what it isn't for, all of that. So really, really good. It's done by a third party and can mitigate a lot of the misunderstandings that may come from salespeople, if that's a good word for it. So non-borrowing eligible spouse. So a nice thing that they added to reverse mortgages again over the years when they saw what was working versus what was not working, was greater protections for spouses that may not be 62 at the time that the reverse mortgages being obtained, but still need that protection for if something happened to that borrower that was 62 or older. So their eligibility, they can be under the age of 62. It's not a requirement that they be 62. They do have to be married to the borrower at the time of the loan. And on the loan, they do have to also be declared as a spouse on that loan. So both of those very important. And then they got to live in the home as well, must maintain the home as their primary residence, and keep up with property taxes and insurance, just like the borrower would be required to do as well. All right, so property eligibility, think pretty much anything. Single family homes, 2 to 4 unit properties, again, primary residence, condominiums, townhomes, manufactured homes, new construction. Obviously, nice thing about new construction, at least the probability is there that it would be less likely that there's maintenance and repair items needed in the near term, which is sometimes ideal for people on fixed incomes or lower cash flow at that time to mitigate some of that risk. Just like with any FHA condo, FYI, it does have to be on their approved list, HUD's approved list. Just double check that or work with a lender that does check that, because it is super important. You don't want to get yourself stuck without an approval and then having to go through the process after they're in contract, which if it wasn't known at that time would be a surprise that just comes with unknown timeframes, which no one loves. All right, so the nice thing from your guys' perspective, a lot of reverse mortgages are understood to be refinanced, right? Like someone takes their current mortgage, refinances into a reverse one, or they already own their home free and clear and they refinance into a reverse mortgage. But the nice thing that not a lot of people are familiar with is that you can use the same product to buy a home. And so the buyer let's say they were doing a purchase of a home using a reverse mortgage, they make a one-time down payment, and then the reverse mortgage covers the rest. There's no monthly payment requirements. So how they determine the down payment amount, down payments typically range anywhere from like 35 to 65% of the purchase price. Maybe even a little higher, maybe even a little, like, it's really gauged based on the two largest factors being the age of the youngest borrower and then current interest rates. So when it says age of the youngest borrower, the reason it says that is, although the main borrower on the loan, at least one of them has to be 62 years or older, if there is that non-borrowing eligible spouse on the loan, they can be less than 62. And let's just say they're 50. Well, because the protections extend to that spouse, they gauge and they essentially build out the amortization and everything that they're comfortable with as far as all the risk factors for covering that 50-year-old, because presumably, all things considered, you hope, that 50-year-old would live longer than the older spouse, and therefore that protection from the reverse mortgage would need to last longer. And so in that case, if the non-borrowing eligible spouse was younger, then they would need a larger down payment. So in other words, lower rates equals less down payment, and then the older someone is equals less down payment required. So if you factor those two in, and they kind of come up with all their different schedules and as far as their lifetime expectancy and all that kind of stuff to determine it. But what they're trying to avoid is a situation where at the end of the day, the house is way underwater, and we'll kind of talk about that a little bit too. So they're trying to do their best that they can, obviously knowing full well that it's impossible to know when someone is going to die or when someone is not going to be able to live in the home anymore, or whatever the case may be. So acceptable funding sources for the down payment, obviously you can, any funds really that are sourced and seasoned, source being the key. They can do proceeds from a recent home sale. If they're selling their home and buying another one, they can use just like any typical FHA guidelines you'd follow here. Gift funds are allowed. Obviously, like anything, it's best that they just try to leave their money alone. Don't move it around a ton. But yeah, all those acceptable sources, just like a typical FHA purchase. All right, so we want to talk really quickly about a real world scenario. So let's say you have a 72-year-old couple. They sell their home for 500,000, and they're looking to buy a new home for 430. So one option they have would just be pay all cash. So option number one is they just pay cash, and then they buy it for 430. They have $70,000 remaining and no mortgage payment. Option two is they could obviously get a conventional loan. They could put 20% down. They'd be left with $414,000 left over, and they would have a monthly payment of $2,175-ish, and that's just principal and interest because that's the best comparative here, because they still have to pay taxes and insurance under any of these scenarios, except for under paying cash. You don't have the insurance requirement technically, although I would imagine most people still have insurance on their home just in case. So the option number three would be you use a reverse mortgage, the HECM, and you do the down payment. Maybe it's about 245,000 that you got to put down. You keep about 255,000, and you are left with no monthly payment requirement. So one of the things to consider would be option two could be kind of difficult sometimes, because although it leaves a bunch of cash remaining, they still have a bunch of cash on the side. They finance portion, then they have the monthly payment. Sometimes, depending on the person's financial structure and their income coming in, their fixed income, they may have a hard time qualifying for that monthly payment when you include that and some other debts they may have. And so although that is listed as an option here, sometimes it's not really an option, where a reverse mortgage could still be, given the flexibilities it has. So something to kind of consider there. So of the three options, so if you think the all cash buyer, they don't have a monthly payment, but they also are very limited on their cash reserves now. So it's great that they don't have a monthly payment, but now they've got to figure out how to live month to month, and maybe those fixed income requirements aren't enough to fulfill their debts, or maybe it's just barely, and so their quality of life is kind of in question there. The conventional buyer has cash reserves but carries a $2,175 a month burden on a fixed income. Obviously not ideal in that situation. And then the reverse mortgage buyer has no monthly payment and significant cash reserves. So those reserves, if you think about it, can cover many years of living expenses, healthcare, or they could be invested. I want to emphasize that this is not a last resort option. It's a strategic financial decision. So sometimes it's viewed as being strictly a last resort, but that's not always the case. And there's many times where what you're really aiming for is that person's ability, whether it be a couple or just an individual, to have quality of life as well. If they are house rich, right? They have a whole bunch of money in their house, but their day-to-day life is a struggle, because they don't have enough money to go to lunch with their friends as they got older, or they don't have enough money to go visit their grandkids because all of their money is tied up in their home. Then it really limits their ability to that quality of life. Becomes a huge It's a huge impact for people that oftentimes gets ignored because they feel like it's almost like in the culture is the more your home is worth, the more equity you have in your home, like hoorah for you. But if you're not able to use it, what difference does it make if you can't use it when you need it, right? Really quickly, I don't want to bog anyone down with a bunch of numbers, but what I wanted to highlight here is this is kind of a typical amortization schedule for a reverse mortgage. You'll see this column here, balance is the loan balance. You see it goes up over time, so it's increasing, increasing, increasing over the life of the loan. And then you also see equity, which initially can increase over time as well. There will usually always be a breaking point where that equity starts to go down. But the reason it increases initially up front as well is because you also, like, the home is also appreciating in value, under normal circumstances, as you guys all know. And so given a 4% appreciation rate, the point at which it no longer continues upward is that year 9 going into year 10, and then that trajectory starts to go down. But you can see even after 25 years of this reverse mortgage and it growing, 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 they still are net positive on their total equity in their home, under this, obviously, this scenario. So it's also, some people's notions would be you just lose all your equity like immediately, which is not always the case either. They also have some safeguards in place to try and limit that impact from happening, and trying to help people to manage this. But it's just a different way of thinking on that front. Closing timeline, sometimes there is concern over a closing timeline on a reverse mortgage. There really is nothing to limit the ability under normal circumstances for it to be just as like a regular FHA closing time frame. Maybe it's 30 days, maybe it's 45 days, just a regular timeline, whether FHA or conventional, that you might experience. The main thing being that person, if they're entertaining the idea of a reverse mortgage, that counseling requirement, the HUD counseling requirement, has to be done ASAP. That has to be done before they even get pre-approved. They essentially go through. So typically the flow for myself would be, I'm talking with someone, they're interested in the product, I explain it, I give them some numbers to kind of, we talk through some numbers, so that, again, they're feeling confident, they're feeling comfortable, no surprises. And then if everything is still going good for them and they're still wanting to pursue it, then I just send them right over to the counseling side of things to get that going at the same time as doing a pre-approval for them. Because before they can even do an application, like an official application with an address, they have to have that HUD counseling done. So it's super important. But then everything else runs pretty, it's very similar. I mean, it should be like buying a regular home with a regular loan at that point. So that HUD counseling is the one piece there that kind of changes things, but that's done early before they even go into contract. So spotting some reverse mortgage candidates in your pipeline. So again, think 62 or older. You're not obviously always going to know the age of the person, but if you find out they're not 62, this is not going to work. Could be put on their radar for some future consideration, but you might have people that are the downsizers, that are, selling a large home and they're looking to downsize. They want to preserve the cash from their sale rather than tying it all up in a new home purchase. You could have someone that's looking to relocate closer to children or grandchildren, and the HECM kind of gives them buying power to afford homes in a more expensive market. And then someone might be looking for accessibility. They need a different home better suited to them and their age. And maybe it's single story, maybe it's having walk-in showers, or just limited stairs, or whatever the case may be, but perfect for their forever home. And then you could have someone that's just looking for cash flow, right? They're house rich but cash poor, like I mentioned before. They want to eliminate their existing monthly mortgage payment to free up income for retirement, or healthcare expenses. Obviously, they're going to presumably have a lot of those, or they just want to be able to enjoy their day-to-day life on that fixed income and not have to worry about that mortgage piece being so much of their budget. All right, so top five myths you will hear, and then the facts. So myth number one: the bank owns the home. The borrower retains full title and ownership, just like a traditional mortgage. So at the end of the day, the bank doesn't own the home more on a reverse than they do on a regular mortgage. Myth number two: my kids will be stuck with the debt. The truth is, HECMs are non-recourse. So heirs never owe more than the home's appraised value. You can't ever have that issue of them being stuck with that debt. Myth number three: I can be forced out of my home as long as the taxes and insurance are paid and the home is maintained. You cannot be evicted, and that is nothing unique, by the way. If you don't pay your taxes and your insurance on a forward mortgage, it's not good either. You're gonna have struggles. You're gonna have difficulties if that's the case too. So there's nothing unique about that. But anyways, other than that, you're not going to be forced out of your home. Reverse mortgages are too expensive. It is like the thing is, it is more expensive than a traditional forward mortgage, but you're receiving more for that money in the form of protections. You're receiving just the product. You're getting more for the product. So although it's more expensive, you're also getting more out of it. I guess I be the best way of saying it. Myth number five: I must own my home free and clear. No, you can have an existing mortgage, and the HECM will just pay that off first, or you can be looking to buy a home using a reverse mortgage, and not obviously you don't have enough to pay the whole thing, so you're only putting down a certain amount, whatever the requirement is, or more if you wanted to, for the reverse mortgage, and then the rest is financed. Um, so that's not true either. All right. Here's one that I think is going to be really, really important. Why reverse mortgages got a bad reputation. So if any of you don't know, which I'd be surprised because you're in the business, typically if you bring up, or historically if you brought up reverse mortgages, it didn't have the best reputation. So what I wanted to kind of do is walk through some of those challenges and what has changed since, because it is a completely different product than it was all those years ago. So the first reverse mortgage product was created in 1988. So a long time ago. And since that time frame, it has experienced a ton of challenges and then gotten to where it is today, which is significantly different and more improved and a lot more beneficial. So what went wrong? Aggressive and misleading sales tactics were a problem, probably still are. I mean, anytime you have sales, it can get, people can be weird, but it'd be advertised like with the terms like free money or you can't lose your home. It just misleading, right? But a lot of that has been taken care of with obviously all the regulations that you guys are very familiar with on the forward side as well. They hit these ones as well, and you have to be very careful what you do say and you don't say in relation to any mortgage, but especially true on reverse mortgages now. There was cross-selling abuse as well. So someone might like me, so someone in my position might tell someone like, hey, you should get a reverse mortgage, and then they set up the reverse mortgage, and then they push borrowers to then invest those proceeds, so whatever they save. So think of that cash in that example, like the $255,000 that was left over. They'd be pushing those borrowers to invest those proceeds into like annuities or insurance products, because then they would get like a kickback from that, right? Obviously, kickbacks, all that stuff has been addressed, and a huge no-no. And so that type of pull through or push through of this product has been largely taken care of because those kickbacks are no longer something that is allowed. Um, Lack of financial assessment. So if you remember, I kind of mentioned that now they have to, their gauge, the borrower does have to qualify in the terms of uh, having an analysis done on whether or not they can actually pay the taxes and insurance in the future. And that was not always the case. So a lot of people, if you think about what that would cause without that assessment, borrowers, if they weren't evaluated, some of them would fall, like have the inability to pay those taxes and insurance. and then they would default and there'd be a foreclosure. And this just fed the narrative of, reverse mortgages cause people to lose their homes. And so that has been like overhauled completely. You're not having that type of pull through that is just people that cannot pay it at all. Poor marketing choices. It's often marketed in the past as a last resort. Sometimes people still think of it that way. It is so far from that type of product. It's not even funny. It is a strategic product, and I haven't even talked about because we're limited on time. But there's a whole other side of this reverse mortgage that maybe we can have a bigger class on. That's more sophisticated. It has to do with the line of credit that's attached to it. Extremely powerful line of credit. We're not going to go into it now, but this can be a very strategic decision that does not mean someone is poor or broke or doesn't have any money. It's quite the opposite in a lot of cases. And then spouses getting displaced prior to those eligibility, like the non-borrowing spouse had less protections in the past. So if the primary borrower died, then that non-borrowing spouse is on the hook for like, okay, well, now you got to figure out what to do with this home. Where now they've extended those protections. So what changed on the right, you can see a whole bunch of stuff. Obviously, the HUD counseling was a huge one as well, because this HUD counseling is third party. It's checking, it's gauging the knowledge of that person that's getting it. And yeah, it's walking them through it. The loan officer cannot choose the company, nor can they sit in on it. They can't do it. It's like completely third party. Obviously, non-recourse protection is super helpful as well, as people are not left with stuff after the fact. All right, so maturity events. At what point does someone have to do something about this home? So if you think of the different options, you have the sale of the home. So borrower can choose to sell the property, right? If they want to, they can do that at any point in time. The loan will be paid off, and then any proceeds up and above the loan is just their equity, their remaining balance that they take, just like a regular mortgage. The borrower could pass away, and in which case the heirs have up to 12 months. So there's a whole time frame that they got, but there can be extensions as long as they're actively working through it. They can sell the home, they can refinance the home, buying it themselves essentially, or they can walk away. If they no longer have it as their primary residence. So if the borrower moves out or lives elsewhere for more than 12 consecutive months, that would be considered a maturity event. And then failure to meet obligations. So if you stop paying property taxes or insurance, or you stop maintaining the home in a reasonable condition, then that could be a maturity event as well. It's 2:30. If anyone, I'm going to go ahead and flip over here. If anyone has to go, totally understand. This is a challenging one to get into 30 minutes. I'm not going to lie. There's so much that has been kind of left out, but I wanted to prioritize kind of the understanding from you guys' standpoint of what it was and what it isn't. But there's more than anything, what you read of horror stories in the past, many, many years ago, or people's conception, it is largely different post like 2013, 2014 than it was then. And so many people out there, I think, are hurt by the fact that people just don't understand what this is now. So anyways, Monica, I don't know if if anyone has any questions that they've been putting it in the Q&A. We can take a couple of those. People, you can hop off if you want to. If you got to go, I totally understand, but we can also entertain some questions here.
You got through a lot of content in such a short amount of time. There's so much to talk about with this program. I totally agree, Jared. But we do have a couple questions. So the first one is, excuse me, how much higher are rates on a reverse mortgage than a regular FHA?
So then a regular FHA, it's going to be typically, now remember, everything varies because their profile matters for risk purposes, but usually about 0.5% higher. It's not a lot. It's not as much as people might think.
Awesome. And can a borrower make payments if they want to?
Yeah. So if a borrower wanted to make payments on their reverse mortgage, they wanted to pay principal and interest and lower that loan amount, they certainly can. So it is something that they could do 1 month and then not do it the next. I mean, any of that is totally up to them if they wanted to limit the impact of the loan growing.
Perfect. That is all the questions we have for today.
Sweet. Good deal. Well, thanks everyone for hopping on. Appreciate it. And if you have any other questions, please feel free to reach out. No big
And we'll
deal.
be sure to get the recording out so that you can watch it again, and just take in that information because there was a lot given today.
Awesome. Thanks, you guys.
Bye.